everybody. Good afternoon. Welcome to today's webinar titled How to Swing Trade with Confidence. Glad you guys can be here. Gorgeous Wednesday afternoon. I just want to do a quick sound check, make sure you guys can all hear me okay. I am streaming live on YouTube and of course GoToWebinar. Those of you guys in GoToWebinar, just shoot me a little I hear you, ready to go, just so I know that you guys can hear me okay. Broadcasting again live. Once I get that, there we go. Thank you, Raphael, appreciate that. Thank you, Randy, awesome. All right, guys, well, today we are going to talk about two swing trading strategies. There are many, of course, different types of strategies and techniques and indicators that you can use to swing trade. Today we are going to talk specifically about two continuation patterns, the ascending and descending triangle. So good stuff today. Take some notes, take out a pen and a piece of paper, take some notes, and get ready to learn. My name is Jerry D'Ambrosio. I'm the manager of educational content here with VectorVest. Let's see, 3 months from now it'll be 20 years since I became a member of the VectorVest team. So it's been a great ride, learning how to make money in the market and get paid for it. It doesn't get any better than that. But I appreciate you guys are here. Now we do have a lot to cover today. I want you to stick with me to the end. If you stick with me to the end, I will share with you a copy of the slides that I'm using. You'll also get a recording later on. Maybe later on this evening you can view the recording, or of course if you weren't able to join us live, you are listening to the recording. I'll send you guys a copy of the slides. All right, so just let me know by the end and just say, hey Jerry, don't forget the slides. I'll put them in the handout section of your GoToWebinar control panel. Okay, I'll direct you guys where that is a little bit later. I usually forget. I have a lot of content to cover. Somebody remind me at the end. Okay, I'm excited to have you here today. Today, again, this session is on mastering ascending and descending triangle patterns, two of the most powerful tools in a swing trader's arsenal. But before we dive in to the technique itself, I want to start by addressing something that may be holding you back from becoming a consistently successful trader. We always look at the end game in mind, right? I want to make this per year. I want to make 20% per year. I want to make 25% per year in my swing trading portfolio. Totally doable, by the way. You can probably exceed that. I think that what we have to do is, instead of looking at the end in mind, let's focus on what it's going to take to get there, right? So being consistent and being consistently successful takes a process. How many of you have ever looked at a chart in hindsight and thought, I knew that was going to happen, but I didn't take the trade? Or maybe you entered a trade with confidence. You liked the setup, really good setup, market conditions were on your side, and you second-guessed yourself. You exited too early. You took the trade at the right time, but you exited too early. Watching the stock take off without you. I've done that before. Recently, still do that. You try not to do it all the time, and you try to follow a plan. We're all human, so human error is going to come into play sometimes. But as long as you understand and have a plan, those situations will be minimized. Even worse, you found yourself caught in a pattern of inconsistency. Some trades worked, some trades didn't, and you can't quite put your finger on why you're struggling to get better. Now, you're always going to have losing trades, right? Dr. David Paul called them, referred to them as a cluster of losing trades. 3, 4, 5 losing trades in a row. That's going to happen. You want to minimize those times as well, but you do need a repeatable process. The truth, most traders who struggle with consistency aren't lacking knowledge. They're lacking a plan, structure, a proven system, and confidence in executing it. And that's exactly what we're going to work on today. Many traders, they see patterns forming, but they hesitate to pull the trigger because they don't fully trust what they're seeing. Others enter trades but don't have a structured plan for when to exit. That evidently leads to emotional decision making. So a lack of clarity on when to exit and enter. A couple of deadly sins of investing are in play here. Fear of losing causes trades to be exited too soon, right? Maybe you have a small little loss, the market may be turned over, and you want to cut your loss sooner. No other reason but not to dig yourself any deeper. You didn't hit your stop yet, but you didn't want to lose any more than you already did. On the other hand, greed leads to holding on too long. Okay? Impatience makes traders jump in before the pattern is fully formed. You think it's going to break out, you have that feeling it's going to break out, and you enter during periods of consolidation. There's nothing worse than doing that. I've seen so many times where price consolidates even after a strong uptrend, but doesn't eventually break out, winds up breaking down, and you get clobbered. You shouldn't have traded in that period of consolidation. So letting emotions dictate trading decisions, one of the things you got to work on. Many traders win big, but give it all back on a few bad trades. They either risk too much after, let's say, you got a couple of good wins in a row, and you start doubling down, maybe not doubling down, but just leveraging up carelessly. So you're risking too much. You set yourself up for emotional pressure that way, because man, now you're kind of pushing the envelope a little bit. You better be right. Or they just risk too little, making it impossible to eventually grow your account. So we're talking about inconsistent risk management. Risk management has to be consistent across the board. Okay? By the end of this session, you'll have a repeatable process that you can apply to your trades immediately. Whether you're trading stocks, trading options, crypto, ETFs, it doesn't matter. Okay? So our goal today is simple. Teach you a proven framework for trading triangle patterns. That framework does apply to different techniques. The framework, guys, is confirmation, profit target, stop loss. Understanding all three of those aspects of kind of the, it's like the anatomy of a trade. Okay? Just a few thoughts before we start. Talked a lot about consistency so far. Consistency isn't about being right all the time. You're not going to be right all the time. It's about having a process that gives you an edge over time. So if you struggled with inconsistency, this webinar is designed to change that. But knowledge alone won't do it. You need to commit to applying what you learned today. Take notes, ask questions. I will stop along the way if I need to, but Ray Clark is in the background. He'll answer any questions that you guys have. But definitely ask questions if you need to. Okay? So I encourage you to take notes. Most importantly, take action. All right? Let's get into it. Today we're diving into two of the most powerful chart patterns for swing traders, triangles, the ascending triangle and the descending triangle. These patterns are commonly used by traders to identify potential breakouts and breakdowns, helping them enter high probability trades. By the end of the session, you'll have a solid understanding of how to trade them effectively. So let's start by defining what these patterns are and how they work, and we will look at a few examples in a little bit. Triangle patterns provide traders with well-defined setups, making them excellent tools for both beginners and experienced traders. Well-defined setups. Again, confirmation. When do I enter? When do I exit? Exit either at a loss or at a gain. And there's a rhyme and reason to both of those, all three of those really. But your profit target, there's an expected move that the stock might make after it breaks out, and once it gets there, that is the area that you want to take action and take profits. And there's also your stop loss, where there's a level on the chart, there's a price at which you're wrong on it. you're wrong on the trade. Price broke down after you took it. It broke its pattern of either higher lows or lower highs, and you exit the trade. So they offer clear entry and exit points. I love how it's how they kind of set up reliable risk to reward ratios, meaning most of the time you stand to make more than you lose. You stand to lose on the trade. So you might be a 2-to-1 or 3-to-1 ratio, your reward to risk. I like that. That means that you can be wrong a few times and still make money. Be wrong more than you're right and still make money. When used correctly, these patterns can greatly improve consistency. Let's start with the ascending triangle. This pattern is categorized by a flat resistance level and rising support. Buyers step in at higher prices, creating a series of higher lows, while sellers hold the price down at a resistance level. Eventually, and generally, not all the time, the buying pressure outweighs the resistance, leading to a breakout. It's not 100%, so you wait for the breakout and you don't trade within the consolidation pattern. So here's what it looks like on a diagram. We'll look at an example, some chart examples, but on a diagram, here's what it looks like. Here's resistance, a horizontal resistance level. Here in this diagram, we had 1 touch, 2 touches, 3 touches, 4 touches. Okay, so selling pressure in that zone. On the other hand, what you're seeing here, we're not seeing kind of a horizontal channel, right, where buying pressure holds at the same level. Here, buying pressure is increasing incrementally, and buyers are buying shares at higher prices as price struggles to break above resistance. So higher lows are being put in, so kind of forming a triangle pattern where you have these converging lines, but it's an ascending triangle because your lows are ascending. Your lows are getting higher and higher. I didn't talk about volume yet, but volume is important. Generally, during this period of consolidation, volume will dry up at times. Okay, and that's what you really look for. You look for a drying up volume, low volume during these periods of consolidation. So you're waiting for a breakout. That's the signal. You're waiting for a strong breakout, not an intraday breakout, a closing a strong breakout where price closes above the resistance level and near the high of the day. Not a long upper wick where you're closing right back into that zone. Needs to be a strong close, and you also need confirmation the next day. Okay, if you do get those things, and that breakout, by the way, needs to be accompanied by strong volume, not just a weak breakout on low volume. That's not a strong signal. You get followed through the next day. You take the trade. Now you have to figure out where you're going to exit at a loss and where you are going to take profits. You already knew where you were going to exit at a loss. You already know where your stop loss is. Well, you really know where your profit target is as well, even before you take the trade. Because once price breaks out and then you see the next day you're going to get follow through, your stop loss is always going to be right below the last low in that period of consolidation. Okay, so right before the breakout, that last low that kisses that lower trend line, right below that is your stop loss. Okay, clear? Your profit target is the width of the triangle. That is known as an expected move, a measured move. You're measuring the distance between the kind of the middle part of the triangle. I usually use the middle part of the triangle. I don't need to be so ambitious that I'm going to use the fat part of the triangle. I'm not too conservative where I'm going to use the skinny part. I'm going to go right in the middle there. I'm going to figure out, I'm going to kind of draw a line and subtract that price by that price. So it's just drawing a line from a retracement off of resistance right down to the trend line. Can I draw a line? I probably can. So I do this. Whoops. Hold on one second. Hold on. There we go. Okay. I'm going to draw So something like this. I draw a line like that, connecting there. I subtract this price from this price. I take the difference and I'd add it to the closing price of the breakout candle. So let's say, for example, this resistance line is 30 bucks, and right down here to the lower trend line is 20 bucks. That's $10. I'd add $10 to the closing price of the breakout candle, and that would be my profit target. Okay? Once your profit target is reached, take action. A couple of things you can do. You can close the whole trade, obviously, or you can close half. If you close half, meaning you just sell half your shares, you book half your profits. Let's say you're up $1,000, you take 500, you close half your shares, you booked 500 bucks, you got 500 bucks still out there. What you do is you take your stop loss, which at its original level, and you raise it to your cost basis at the very least. That way, even if price does reach your profit target, you take profits, but then it comes back down. If it reaches your cost basis, you close the remainder of the position. You close the balance of the position. You didn't make any money on the balance. You gave that back, but you still booked profits, so it's a net winning trade. Another guideline that I like to use, we have a kind of a general guideline at VectorVest in terms of risk management and profit taking. Don't give back more than half of your profit. I will apply that to the balance once I take profits at my profit target. So really, instead of raising my stop from its original level to my cost basis, I'll even raise it a little further and put it halfway between my cost basis and my and my profit, and then not give back more than half of the balance. So, for example, if you got $1,000 gain, I reach my profit target, I close half of it. I booked 500 bucks, I got 500 bucks left. I won't give back more than 250 of that 5, and then I'll close the position, wind up being a $750 profit. Okay? We'll look at some examples as well, but just a few more characteristics here. First, price forms a strong resistance level. It acts as a ceiling. Second, buyers continue stepping in at higher levels, forming higher lows. I said earlier that volume typically declines as the pattern forms and expands once the breakout occurs. So recognizing these characteristics will help you spot high probability setups. All of those need to be in play, especially high volume, strong volume on the breakout. To trade an ascending triangle, wait for a confirmed breakout above resistance with increased volume. Enter a long position once the breakout candle closes above resistance. The following day on confirmation, your confirmation price is going to be the close of the breakout candle, the closing price of the breakout candle. Place your stop loss below the most recent high or low, and your profit target can be estimated by measuring the height of the triangle and projecting it above the breakout point. So here's KGC. So I'm going to give you these slides later, but I'll go through this maybe a slide or two now and then go into the program. So here's KGC. Let's look back, let's say July, August, right in that area, 2024, right? So price failed to go above, we'll call that 9.25. Price failed to go above 9.25. Price failed to go above 9.25. Price failed to close strongly above 9.25 before pulling back. So right in this area here, it's establishing a 3-touch resistance level. At the same time, what we're seeing is buyers coming in and putting in higher lows, right? Exactly kind of like the diagram that we looked at. So what we do is you wait for the breakout, which happened right here. Let me do laser pointer again. Yeah, right there. There was your breakout. I'm sorry. That big unfilled green candle was your breakout. And that also, you had some nice volume coming in there. Look at how volume, for the most part, I'm not saying every day was low volume, but in this area here, you had some lower volume days, particularly kind of towards the end of the triangle, right? And that's another earmark of a ascending triangle pattern. Breakout on that day, follow through the next day. Okay. Set your stop loss. Right below the last high or low before the breakout. And here's your confirmation day. All right. Let's talk about legging in and where maybe to add to your position. So you had the breakout, you took the trade, and a lot of times what happens, we take a trade immediately and price falls. It fell for the next 3 days after we took it. This is now a support level, right? So a lot of times when you'll see price establishing resistance and then eventually breaking above it, that zone is in play now as a support zone, as a floor. Price fell for the last for 3 days after you took it, and then stopped at that support level and retraced. So if you took a position on the breakout, you can add to your position on a successful retest and retracement of support. Okay. Now my profit target I would have drawn it kind of. This is the breakout, so I'm going to look right in this area here, kind of right in the middle of that triangle. I'm going to take that price at about $8, and I'm going to subtract it from that price, which is about 9 1/4. So $1.25 would have been my profit target. So I would have added $1.25 to, let's say, $9.75, and you're looking at about $11 as your profit target. That is a measured move. That's where you should expect at least price to move to in the near term. Here what it did is it retraced immediately to support, retested support, retraced from it. You could have added to your position maybe here. Could have added to your position if you wanted to again here if you started with a smaller position. These successful retests of support and eventual retracements off of them are where you can add to your position. This actually hit just about $11, so our profit target was reached, and you close the trade. This is a good example. Okay, here's another one, SNEX. Let's actually go into the program. How can I do that? Let's go in here. Let's look at SNEX on a real chart. Oh man. All right, I'm going to go back. Where was I? Oh, I got to clean up this chart a little bit. Hold on. And whoops. We were looking at August, September 2024. I see. Right there. Okay. So let's pretend that this is the hard right edge. We're on October 2nd of 2024. What do we see? Well, we see an uptrend, right? But we also see a potential weakening of that uptrend, because in this area here, middle of September, price failed to break above the old high and retraced from it rather sharply. You guys see that? Okay. At the same time, so we're establishing here, it's almost a 3-touch resistance, because this little rally here petered out. You kind of got into the zone. You can probably split the difference and put the line there, and you can almost have a 3-touch resistance zone there. Okay, it's always not always at the same price. Same time, you're seeing this happening. This pattern of higher and higher lows. Buyers are coming in, picking up shares at higher prices. Price is getting consolidated, and look at volume. With the exception of maybe 1 or 2 days, look at how dry volume got. So this has all the earmarks of a potential breakout. Now you have to wait for the breakout. You don't think I'm going to buy it during consolidation and it's going to break out. Not always the case. Here it consolidated on pretty low volume too, and then eventually broke down. You wait for the breakout. Let's see when we got it. Okay, there it was. Right, big volume day. This is a rather expensive stock, but 100,000 shares traded that day. Big volume day, strong breakout, closed near the high. You got a little bit of a long upper wick, but it clearly closed above that 37.5 resistance zone. Okay, so now I'm going to look to take the trade the following day. So let's set this up as if we were going to take it. What's the closing price here? Closing price was 38.05. I have to make sure that the next day price goes above 38.05. I'm not buying it at any price below 38.05. It's got to go above 38.05. My stop loss, I would put it right below that low. I know that's a little higher than, and it didn't quite kiss the trend line, but it is the last higher low in the period of consolidation. So right below that low is where I would set my initial stop. How I would draw my profit target, I'd probably come right in this area here, right in the middle. And I would say, let's say, and you haven't taken the trade yet. You haven't taken the trade yet, but you're setting all this up first. What price is that? Let's say it's 33. What price is that? 37.5. So we're talking about $4.50. $4.50. I add $4.50 to 38, and we're looking at $42.50, and that's where I would set $42, $42.50, right in that zone. Doesn't have to be to the penny. That's where I would look to take profits if price reached that. So I have a very structured outline here. I know where my confirmation is, I know where my stop is, and I know where my profit target is. The next day you did get confirmation. Now it didn't close strongly the next day, but you got confirmation. Right? Price went to 38.70. Remember what our confirmation level was, 38.05. So price did confirm the next day. Let's see how this one did. All right, pretty good move. Down day, a little consolidation. All right, a little new high. Breakouts underway. Oh, a little bit of a pullback. So we didn't quite get, what's this price? 39.45. We have not gotten to 42, 42.50 yet. So we haven't gotten to our profit target yet. Maybe we're coming back to retest support. Remember where our stop is. We're okay, right? We're still, we got a safety net here, no matter what happens. And you've sized the position correctly, where it's not going to be a tremendous loss. I'll explain how we size a little bit. But now it's pulling back. Let's see, does it come all the way back down to 37.5? And it does. If it does, I can maybe add to the position. Okay, it does. It kisses that zone. And there's your little retracement off of it. I would look to add to the position there. Okay, right off of that little retracement. Worst case at the next day's open if you missed that little move there. But that move the day before, pretty good move on really good volume there. Okay, so you're looking at that and considering taking it. Now we blast off. We retrace from support, and we get to 41.15. We get to our profit target. Okay, 41.80, guys, was the high of that day. When you have a profit target in mind, you got to think of it as your max profit, right? How much of that are you going to capture is the question. We'd love to capture every penny of it, but don't get greedy. If you get to 41.80, almost $42, you've got to look to take profits. Okay? So if you take profits near the close of that day, it closed at 41.64, I'm looking to take profits on that day. What I do then is I raise my stop to my cost basis at the minimum. The cost basis was that long red wick day. That's the minimum. Again, a lot of times what I'll do too is I'll raise it to in between, right in the middle of my cost basis and what the remainder, the balance of the profit looks like. Wow, and I just popped the next day. I mean, successful trade nonetheless, right? This was a really good one. But this was the consolidation period, though, that we recognized. We recognized it. We recognized the breakout, the follow through. Everything was laid out. It was a really good setup there. Okay. Let's go to the next one. All right. Any questions on the ascending triangle? We'll do a recap at the end, but I want to now just kind of jump to the descending triangle pattern. This is the opposite of the ascending triangle. Here, price forms a strong support level where sellers continue, while sellers continue pushing the price lower, forming lower highs. Once support breaks, the pattern typically leads to a significant price drop. Okay, here's a diagram here. All right, let me pull my mouse over. Let's get my, what do I want to do? I want to do a pen. All right, here's my pen. All right, so Whoops, nope. Well, no, what did I do? Hold on. Pen. Thank you. Support, retest, support, retest, support, retest. Okay, so buyers are supporting price here, in this case, from moving any lower. At the same time, though, you're seeing sellers sell shares at lower prices, putting in these lower and lower highs. Okay, you got another one right there, another little lower high right there. What we do, if we're looking to take a short position, you wait for the breakdown. You wait for the breakdown below support, and your confirmation level is the close of the breakdown candle, and there's your confirmation, and that's when you take the short position. If you happen to be long this stock during this period and you see that breakdown, you should jump ship at that point. All bets are off. You got a significant breakdown and a very high likelihood, high probability that stock's going to continue to move lower. If you take the short position here, your stop loss is going to be at the last lower high during or right before the breakdown. And your profit target is the same. You measure the width of the triangle and then add that to the closing price. I'm sorry, subtract it from the closing price of the breakout candle. Okay? So like the ascending triangle, this pattern has very distinct characteristics. Let's review them. Strong support that repeatedly holds until sellers eventually overwhelm buyers. Lower highs indicate increasing selling pressure, and volume generally does decrease during the formation, and then it will expand on the breakdown. Understanding all of these characteristics allow traders to anticipate price moves efficiently and not be late to the party. You know, price breaks out, you wait 3 or 4 days, and you've missed a good part of the move. So we have to be there when breakouts and breakdowns occur. The psychology behind these patterns, I think, is fascinating. With an ascending triangle, buyers are in control. Right? You're in an uptrend. You're creating higher lows as they push price towards resistance. Eventually, they overpower sellers, leading to a breakout. In a descending triangle, sellers are dominating. They're pushing the price down until buyers can no longer defend that support level, causing the breakdown. So understanding these dynamics really help make more just informed, confident decisions. Now, market conditions play a crucial role in the effectiveness of these triangle patterns. Ascending triangles work best in strong uptrends, where momentum supports breakouts. Now, there is not one specific market timing signal in VectorVest that I would suggest to use. I would pay attention to a couple of things: the MTI and the confirmed call. So if the MTI is above 1 and we're in a confirmed up call, maybe even a DEW up situation, then look for ascending triangles. Look for stocks that are also in uptrends, that are consolidating, waiting to break out. Descending triangles are more reliable in weak or bearish markets. So now think, MTI below 1, confirmed down call, DEW down call. And then during those situations, primary wave down days, red lights in the price column of the color guard. Those are opportunities that you can look for short positions. Those are situations where sellers have control. So always consider the broader market context when trading these patterns. For a descending triangle, enter a short position when price breaks below the support level with strong volume. So here are kind of your rules here. Your stop loss should be placed above the most recent lower high, and your target the projected move by measuring the triangle's height and applying it below the breakdown point. So here's DHI, DH Horton. Let's go into, okay, what is this? This is December, January, February, March 2025. So let's go into the program. Where am I? Let's go here. And let's just look up a chart here. Whoops. Okay. There's your hard right edge. Stock is in a downtrend. Let me get rid of these lines. And I'll draw them for us. Okay. Come on. There we we go. All right, so hard right edge, what are we looking at? Beginning of April 2025, what do you see? Well, you see a base forming, don't you? Right? So you can kind of just take it, you draw a horizontal line right down there, connecting those touches at 123. 1, 2, 3, working on our fourth here. At the same time, what are we seeing? I'm going to create an extended line, and I'm just going to connect as many data points as I can here, connecting those lower highs, right? That's probably good, right? In that area there. I got that one, I got that one, I basically got that one, I got that one, I got those. So there's consolidation here. Volume is starting to dry up too. You got one, couple of these big volume days, but for the most part, you're seeing lower volume days, a lot lower than you saw in the past. So what do we wait for? The breakdown on high volume, and then consolidation after that. Okay, so if you're long, you consider taking the position off. I don't know why you were long here, maybe anticipating a breakout, thinking, hey, we got a base here. Didn't quite get the breakout, but you got the breakdown. This thing fell 20% or so in just a couple of days. Okay. WDOFF. So let's take a look at this one. This is also an ascending triangle in a really long period of consolidation there, right? So let's go back in here. Let's go to the viewers, WDOF. All right, remove these lines. I'm going to step you forward here. So what I'm seeing, hard right edge, I'm seeing higher high, but a lower high now put in. Another little lower high put in. So I'm going to take that one away, and I'm seeing this, so I'm going to draw an extended line. Hold on, get rid of that. I'm going to draw an extended line here, kind of connecting those highs, extending that out. Okay. I'm also seeing an old resistance level that was here. So if I snap that line here at old resistance, it's now new support. So now you have a support touch here. You had a false breakout there just at the open, and then a move immediately back into the zone. So that was another retest and then retracement. And here's yet another retest and retracement off of that zone. But we're seeing lower highs being put in. Okay, so it does kind of suggest a weakness by the bulls. Okay, there's a kind of a retest of that. Did that high take out that old high? No, so I can almost kind of do that, connecting those highs. Look at those long upper wicks. That is not bullish. Then we get the rip off of it. So you're absolutely putting in a lower high here. We're getting another retest of support, little retracement, and then a breakdown. And that was it. Look at the volume starting to come in, and the price moved quite a bit lower there for a couple of weeks. An immediate retest of the zone and then a rip lower. But that pattern of lower highs with support suggests a breakdown. And that's exactly what we got. Okay, and there's just what happened afterwards. And again, I like to go in the program. I'm giving you the slides. I also like to go in the program, more so than stay in the slides. All right, let's talk about false breakouts. They can be frustrating, but they can be avoided by waiting for a candle close beyond the breakout level. So confirm the move with volume expansion and use supporting indicators. You can use RSI, you can use MACD to strengthen your conviction. So if you have a breakout, for example, you got a bullish MACD crossover or MACD in bullish territory, that gives you a really strong signal. So, and also avoid trading in choppy market conditions where breakouts are less reliable. Risk management is key. Never risk more than 1 to 2% of your account on any one trade. Okay? I'm going to give you guys an example on how to size a position. Let's use this one. Let's use SNEX. This was our ascending triangle breakout. Okay, we're going to go through kind of an example here of how to size a position. There was your breakout. So I know that my cost basis is going to be somewhere above 38 bucks. Okay, so I can estimate maybe 38.50. You never know, just above 38 bucks. So if my cost basis is right around 38.20, 38.30, where's my stop loss? Right below that low. I know the price too, right? So what is that low? The actual low is 34.47, so 35.40. If my cost basis is going to be somewhere about 38.40 and my stop loss is 35.40, let's figure out what percentage loss that is. So I take out my little percentage calculator. I type in 38.40, 35.40. Those numbers correct? Hold on. 35.40, 38.40. Okay. That winds up being, let's round that up, an 8% loss. Everybody with me so far? Kind of know what my cost basis is going to be. I know where my confirmation level is, so I know where my cost basis is going to be. I know where my stop loss is, so I got to figure out what percentage loss that's going to wind up being. It's 8%. I then take out my calculator and I solve for my cost basis. Okay? Don't risk more than 1 to 2% of your overall portfolio. Stay within that range. So for example, let's say you have a $50,000 portfolio. 1% of that is 500 bucks. 2% of that is $1,000. 1.5% is 750 bucks. Right? I like to live in the middle. I don't shy towards 1. I don't go towards 2. 1.5% on every trade that I place. I don't risk or lose more than 1.5% of the overall portfolio value at any time. So let's plug those numbers in. Let's say 750 bucks is 1.5% of my portfolio. I divide that by, what do we say, 8%. I divide that by max loss of 8%. That spits out a cost basis of 9,375 bucks. If I want to know how many shares I need to buy, I divide that by the current price. But I work in terms of cost basis because that's what RoboTrader takes. You put the cost basis in, you put how much capital you want to use, and it automatically calculates how many shares you're going to buy. So if I took this trade, where is it? If I took this trade, I know going in, I don't want to lose more than 750 bucks. I know my max percent loss, because I figured that out, is 8%, 9,375 bucks. If I put 9,375 bucks in and I lose 8%, it'll still only be 750 bucks. Every position is sized this way. Knowing where your confirmation level is, knowing where your stop loss level is, figuring out the percentage difference between the two, and then figuring out solving for your cost basis using your fixed risk amount for the trade. That number, that 750 bucks in this example, will either go up or go down depending on the performance of your portfolio. Okay? And did we figure this one out? Yeah, we already walked through that one. Okay? Huge rule of thumb here. That is foundational. It's known as a non-negotiable. Okay? Non-starter. You don't take a trade if you're risking more than 2% of your overall portfolio on it. Okay, talked a little bit about scaling in and scaling out. Scaling in allows you to add to winning trades, while scaling out helps secure profits. Enter on the breakout, add on successful retests, and exit at key levels to maximize returns, and then smartly manage the balance. At the very least, raise your stop to your cost basis. If you want to go a little tighter, don't give back more than half of the balance. I think those are a couple of good rule of thumbs. Exit when price reaches your target, or the trend reverses, market conditions change, but never let a winning trade turn into a losing trade. Okay? Avoid premature entries, ignoring volume, trading against the trend, and using stop losses that are too tight. Okay? Couple of big common mistakes that you want to avoid. So, and you also want to stick to high probability setups, not setups that look okay. You know, we want really strong setups. All of the characteristics that we talked about have to be in play. You know, for an ascending triangle, strong resistance, higher lows, drying up volume during that time at times. Doesn't have to be every day or just overall, but you can just noticeably see that volume is drying up. Strong breakout above resistance, not a weak one, not one on lower volume, and not one with a long upper wick as well. And then confirmation, and then, you know, how to manage the trade. Ascending triangles signal bullish breakouts, while descending triangles signal bearish breakdowns. Always wait for confirmation, use proper risk management, and stay disciplined in your approach. Okay? We just went pretty deep here on how to trade breakout patterns. You now see how powerful these setups are. But let's be real, knowing this strategy is one thing, right? Executing consistently, profitably, and with confidence is another. That's where most traders fall short. Let me show you guys something quick. This right here is my swing trading coaching group portfolio for this year. In this portfolio, I trade a lot of different setups that we teach in a lot of our different swing trading courses. Flag patterns, triangles, inverted head and shoulders patterns, all in play. Okay, using all of these different techniques. 16.5, almost 17% so far this year. The S&P, guys, is down 3. So these patterns work. Knowing how to trade them is a completely different animal, and that's what our coaching is all about. We'll talk more about that at another time. But again, most traders fall short. What I want to do here today is I want to give you all the answers. I want to teach you guys how to do this consistently. So what I did and what Dr. David Paul did, Steve Chappell, we put together this course called Precision Swing Trading. It's designed to take you from just knowing patterns, knowing breakout patterns, to actually mastering them, stacking the odds in your favor, building real consistency in your swing trading. We start off with what we call the anatomy of a swing trade, kind of laying the foundation for the course. Price and volume structure, managing risk, position sizing, all foundational, right, in swing trading. Got to know all that before you even learn different techniques. Then we'll go through indicators and scans for trending and channeling markets, reversal patterns like head and shoulders and double tops and bottoms, continuation patterns. We'll talk more about triangles, rectangles, flags, and pennants in Module 5. And then we put it all together and take you on a practical kind of exercise in setting up and executing and managing these trades. All of the course material, guys, you get for an entire year. These are all pre-recorded. All pre-recorded. This isn't just information. It is a complete structured process that helps you finally trade with clarity and confidence. Okay, what I'm going to do, I'm going to show you guys here, exclusively for you folks that are here today. This course is generally listed at $995, but for you guys here today, we're going to knock $500 off, and you get all the material for an entire year for $495. So what I'm going to do is I'm going to put the address, so you can just click on it. You don't have to type it in. www.VectorVest. Whoops, let me spell it right so it does, so you can click on it. Nope, spelled it wrong again. It's an easy one. /PST VectorVest. Let's click on send. Let's see if that works. Nope. It was the wrong site. Hold on one second. www.vectorvest.com/PST. That second one should do it. Yep. All right. Awesome. Now let's talk about our live sessions, because this is going to be a live class. Okay. The modules that I just showed you are all pre-recorded, but we're going to meet live 6 times, actually 7 times, starting next week, April 8th, Wednesday. 1 p.m. Eastern Time is the time of all the mastery sessions, and what we're going to do is just review each module. Okay, mastery session number 1, we'll review module number 1. Mastery session number 2, module number 2, and so on. Okay, now if you don't already have VectorVest Premium, that's our real-time data feed. That includes technical scans, the auto timer, and the watchdog. We're going to give it to you for 70 days. Okay, again, if you don't already have it, if you have it already, it means you likely at some point took out a trial to it, and that's kind of essentially what we're doing here for folks who've never had it before. Okay, we're going to do a 7th session, a live bonus module called How to Short Stocks with Confidence. That's on May 20th. That's also at 1 p.m. When you register for the course, you're going to get an email with all of this information, guys. I know I'm going through a lot, but with all of this, you'll get all of this information. I wanted to let you know we do offer a money-back guarantee on this course. You go through all the entire course. If you're not satisfied, you can get all your money back. This is complete no risk. But you got to do the work, though. We know if you do the work. We know if you watch the recordings and if you watch the session. So, got to do the work, because if you do, you will see the results. You saw my portfolio. Oh, I didn't show you. That's this year. This was last year. 39%. Okay, rolled over some profits this year, or kept some cash available. But that was last year. This is this year. Okay, so www.vectorvest.com/pst. I did put the link in the chat box, so you guys can click on it. Nobody is reminding me, so I'll go ahead and do it. In the handout section of your GoToWebinar control panel, I am going to put the slides that I used today. Give me a second to do that. So you should see in a moment in the handout section of your GoToMeeting control panel, you see a document, PDF, how to swing trade with confidence. Click on that, open it up, download it to your computer, so you have it for later. Okay, because later you will get a recording of today's session. You should get that later tonight. Okay. Again, guys, my name is Jerry D'Ambrosio. Myself and Steve Chappell, by the way. Steve Chappell is our Director of Trading Systems Development. He's also the lead coach in our Jockey Club daily trading rooms. Great trader. He's up about 18% so far this year. So we're kind of knocking the cover off the ball this year so far using these different types of setups. So we'd love to teach them to you. VectorVest.com/PST. If you have any questions, shoot me an email, jerryd@vectorvest.com. But we start next week. We start on Wednesday, 1 p.m. Eastern Time for our first Mastery Support session. So look forward to working with you guys. If you have any questions, let our support department know, or you can email me as well. Have a great day, everybody. We'll see everybody again next week.